Welcome to another Tax Talker. Today we have the state of depreciation in 2025. If you missed my previous video on the business updates, we have increased bonus back to 100% and increased Section 179 abilities as well. But what do these mean and what's right for you? Too often taxpayers are pigeonholed into one or the other. We haven't been taking as much bonus lately because it was lower. But is that the right call in 2025? You don't need to be a tax expert to spot some of these differences, and stay tuned to the end because I have 3 simple questions you can ask your tax practitioner on bonus depreciation in 179. Let's get into it. Let's start with the basics. What is depreciation? Depreciation is how you write off big purchases. Things like buildings, equipment, vehicles. Instead of being able to deduct the full cost of these items, IRS usually makes you capitalize these and deduct the costs over a period of years. This applies to most business property. It's given a useful life that's greater than a year and therefore needs to be capitalized. This is really going to be everything that's not inventory or supplies that's over a de minimis threshold of $2,500. But bonus depreciation Section 179 exists as a way to accelerate these deductions and take them up front. So let's start with bonus depreciation, as this is the simplest. In fact, it's really part of the maker's system. It's found in the same IRS section code of 168 and follows standard depreciation principles. It simply lets you write off a given percentage up front before going on to calculate the rest of your maker's depreciation for that year. Because it's a percentage, it's very easy for Congress to play around with, and indeed it's been up to 100%, and it would have been as low as 40% in 2025, and it would have continued to phase out to 0% in 2027. But now the One Big Beautiful Bill has put it back at 100% for 2025 and made permanent, or better put, until Congress changes it again. To qualify, the property has to be new or new to you, and it has to have a useful life of 20 years or less. This is going to include all types of machinery, equipment, even big equipment, computers, furniture, and even certain types of improvements to buildings. It applies automatically, and it's all or nothing for a given asset class. You would actually need to make an election for that class of property to elect out of bonus rules for that year. So bonus can be a huge write-off, but because of that all or nothing and those elections, it can be clunky and can lead to missed tax savings if you don't think this through. All right, Section 179 is another way to expense property right away in the year it's placed into service. But it works differently. In fact, it's not technically depreciation. It's governed by a different section, Section 179. And that deduction replaces the depreciation deduction eligible under Section 168. Section 179 provides a lot of flexibility. You choose which asset to claim 179 on, and you choose how much to take. If you have equipment of $200,000, you could take $68,967, and that remaining amount, which I did not do the math on, then would go into the maker's formula. It would be eligible for bonus depreciation and then eligible for normal maker's life over whatever the useful life of that asset is. Section 179 is subject to limitations based on the total amount of eligible 179 property placed into service each year. This is a way of phasing out very large businesses that are acquiring millions of dollars worth of property. Once you hit that $4 million, you then start entering a phase-out range where not only are you capped at the $3 million, but that $3 million actually starts decreasing as your assets go over $4 million. So that's the way the phase-out works. Section 179, because it's this special deduction, also is subject to an additional limitation on total business income. So you need to have business income in order to take the deduction. The important ramification here is that Section 179 cannot drive up an overall net business loss. It doesn't necessarily mean you can't take it, but you would then have to carry over the excess unused Section 179 to a future tax year. You start to see some of the similarities and differences here, but let's get into 3 simple questions you can ask your tax practitioner that gets to the fundamental decision between, do I take bonus, do I take Section 179? Number 1, how does my state handle Section 179 and bonus depreciation? Many states don't conform with federal. They might not conform on bonus, they might not conform on 179, they may have a muddled system on both of them. For instance, in my state of Minnesota, business owners must add back bonus depreciation and deduct it over a 5-year period. So it could still be accelerated because you could have bonus depreciation on qualified improvement property, normally depreciated over 15 years, take the full write-off against federal, but I'm spreading the rest of it over Minnesota for 5 years. So on that case with qualified improvement property, that's not eligible for Section 179, so I'm going to take it. But on equipment, I'm likely going to look to Section 179 first to avoid that Minnesota add back. And in the past, Minnesota's had limitations on Section 179, and many states still do. So you got to know what your state favors, if any, in order to help make that decision. Number 2, does my income type and amount affect my ability to deduct Section 179 or bonus depreciation? We already got into this a little bit with the business limitation. Again, your Section 179 is limited to having business income. So if you're towards break even or at a loss, you're going to be limited. And where that can be significant is if you have a bunch of non-business income. For instance, your W-2s. Maybe you're an S-Corp, so you also get a W-2 from the business, or your spouse is working. You could have substantial investment income, rental income. You could have income from any number of sources. That can be offset by a bonus depreciation, by an active business loss. But in contrast, Section 179 would be limited. If net business profits gets to 0, that's the extent to your loss, and it's not going to offset those other income types, whereas bonus depreciation could. On the other hand, bonus depreciation, because it's clunky, it's all or nothing, it could lead to a big net operating loss or 461 business limitation loss that maybe you just don't want to get. It'd be easier to just elect out of all bonus, maybe have useful property of 5-year, maybe just take it over the 5-year. You don't need to create this massive loss that's going to be hard to use. Number 3, could we be using Section 179 to better manage tax brackets and income phaseouts? This one is huge, and if the first 2 didn't affect you, this is where there's a lot of planning opportunities, and planning ahead can make a big difference. Bonus depreciation is all or nothing. You either took it or you didn't. Section 179 provides a bunch of flexibility. You decide what asset to take it on and how much to take. This provides perfect flexibility for managing income phase-out ranges. We have a whole bunch of these new in the One Big Beautiful Bill. Things like the tip credit get phased out at a certain income, or things like the specified service trader business for QBI deduction paired with the state and local tax deduction, SALT cap. Those are getting phased out at the same time, around 500,000 of income, leading to very high effective tax rates. And these are all over the tax code, these different phase-out ranges. So using Section 179 to manage these can be very powerful. Beyond that, though, there's just the tax brackets themselves. We have a progressive tax rate system, meaning the more income you have, the higher the rates you pay. But as you take deductions and go down the income rates ladder, you're not utilizing those deductions against the highest brackets anymore. Taking bonus depreciation and wiping income out entirely, it can be nice to have a tax holiday, but you used hundreds of thousands of your deduction against the lowest brackets, against the 12% and 10% bracket, meaning you're saving 10 cents on every dollar. Fast forward to the next year, you're back in 32, 35% bracket, you're paying high rates again. It could be far better to take Section 179 to get out of the highest brackets, but then leave some deduction left for future tax years. This is all the more important if you finance the equipment purchase. If you're taking a big write-off in the current year and then having a big loan stretching out where you have loan payments but you're not receiving much deduction other than the interest on that loan, that's why you might consider taking Section 179 up to a point and then stretching out the remaining deduction over many tax years. This is the power of Section 179 and really what they call tax efficiency. You're using the deductions against high brackets, knowing every year you're going to have tax expense. It's a matter of managing your tax brackets and your exposure to high rates. There you have it. That's depreciation in 2025. Important takeaways: bonus is back at 100%. Section 179 has never been bigger. But which do you take? How much do you take of it? Those are the tax planning questions, and you don't want to just do what you did last year. That's not the automatic right choice. Talk to your tax practitioner, ask them those 3 simple questions. And hey, thanks for watching. Hit that like button, leave me a comment. I'd love to do a video on a viewer question, and subscribe for more tax talkers. Thanks for watching, everyone.